Hi, everyone. Thank you again for joining today's webinar on what kind of fund are you running. I'm Vanessa Samaniego from 500 Startups. We're going to give folks a few more minutes to join. So in the meantime, check out the Q&A and chat functions at the bottom of the screen. If you have any questions for our speaker today, we're going to be really monitoring the Q&A function. Great. I think we can get started. So thank you again. We're excited to welcome you to today's What Kind of Fund Are You Running webinar with Michael Lyons, operating partner of Riffian Investments, CEO of Rapid Ascent, and co-academic director of VC Unlocked Silicon Valley Online. For those of you who just joined, my name is Vanessa Samaniego, and I'm in charge of operations for 500's investor education programs. We'll be taking questions throughout the presentation. However, I kindly ask you to post them in the Q&A function at the bottom of the screen. Mike will be presenting for about 35 minutes, and then at the end, we have reserved about 10 to 15 minutes for the Q&A. Before we get to the webinar, I wanted to speak a little bit about our upcoming VC Unlock Silicon Valley online program in collaboration with the Stanford Center for Professional Development. This program is taking place this fall, October 4th through the 29th. We're going to drop a link into the chat so you can learn more about the program if you're interested. But the general application deadline is coming up on July 30th. So please remember that if you are interested, the first step is going to have a peer or colleague submit a nomination on your behalf. So be sure to take care of this as soon as possible. The program is really designed for serious investors that want to strengthen their ability to define, negotiate, and execute early stage investments. So feel free to send us an email with any questions to vcunlocked@500startups.com. And with that said, I'm really excited to hand it off to Mike now.
Thanks, Vanessa, and welcome everybody. We'll hopefully have a little bit of fun here for the next 30, 40 minutes. And please feel free to try to interrupt in the chat if questions that come to mind. I think we have a wide range of backgrounds and interests here attending today. And there's no such thing as a dumb or inappropriate question. Just fire away. And then we'll have some time at the end also for questions. As Vanessa said, I'm Mike Lyons. I have a long history in venture capital across, now we'll call it 6 different funds. Riffian is the latest instantiation of that. I'll explain a little bit later on how we actually do stuff, because it may be interesting to some of you, but it really has to do with how you focus your activities, and each one of you will have a very different focus, I think. Also, one of our portfolio companies in our fund is a new cyber academy called Rapid Ascent, and I'm currently running that company. So, what else we got to do, right? So let's go to the next slide. So what I'm going to try to cover really fast, over the next 30 minutes or so, is a little bit of a review on venture capital, and then we'll get into some focus areas which you'll want to pick up on for deciding what kind of fund you actually want to run and what does that look like, which includes things like, okay, what portfolio size are we targeting? What staffing and things like that do we have to handle the workload? What's realistic, against the objectives that we've laid down for the fund, that sort of thing. A lot of folks absolutely need to start, if you're just doing it for the first time, with a small fund. We'll talk a little bit about Floodgates history, very, very successful fund. It started very small. And as you may have joined or be part of much larger funds, or sovereign wealth activities, things like that. And then you have a much broader portfolio strategy and you're managing much larger check sizes. So talk about that a little bit too. So at the end of the day, you need to decide, what you want to do, and then build a situation that allows you to be successful there. And I'm going to go through some background stuff real quick and make a suggestion for some work that you could do. And, feel free to interact or, say, gee, this is dumb. I know all this stuff. Just go faster. So we can do that too. So let's just review real quick what we're talking about here on venture capital. And, everybody knows, hopefully in this audience, this is equity financing. We're giving new enterprises money in exchange for equity and ownership in their companies. And, venture capital is unlike what I think probably the public thinks, as this is gambling, dice rolling, let's tightly structure some kind of financing around this new company, or take a lot of debt in the thing. That is not what we're talking about here. And we're definitely not talking about anything that looks like financial engineering. That's the purview of private equity. And if that's what you want to do, which means you're going to write very large checks and you're going to try to double your money in 24 months, this is a financial engineering project, and your team better have some really sharp financial engineers on it. If you're doing venture capital at the earliest stage, you can forget about structuring the deal. That is not how you're going to win. This is about building alliances with the early stage founders and creating win-win situations. So a very different approach and a very different set of skills. And all of the obvious things apply here. As the funds increase in size, because of the investment timetable, which typically is in the 3 to 4 year range, you have to write much larger checks as the fund is really big, because otherwise you cannot deploy the capital. And one of the biggest problems that most VCs have is bandwidth. They just don't have enough hours to properly deploy the capital. And so you also have to remember that when you're running one of these kinds of funds, you're probably going to spend most of your time saying no. And potentially you're going to reject 98% of the things that you see. And so you can see right away that the bandwidth and the cycles that you have to do this work are heavily impacted by that process. And this is particularly true the larger the fund gets. And we'll talk about this a little bit later as well. You could have a geographical focus for your fund. You could have a stage focus, early, mid, or late. And frequently, most folks need to have a sector or a set of sectors that they're going to go for, because otherwise you're trying to boil the ocean. And this becomes extremely difficult, especially if the fund is very early. And this is the first one you're doing, and it's not very big. So you really need much more and more and more focus. Whereas if you get to really, really large, assets under management, like like a fund like A16Z, well, then you can really have multiple sectors and teams that are focused on those sectors. So you're just kind of scaling the fund up that way. That works too. Um, just a recap. This is probably something everyone knows. I hope so. Um, this is the way these funds are structured. Each fund is a partnership, usually. Why is that? Tax purposes. We need structures that are pass-through entities for taxes, so that the funds themselves are not taxed by the gains in the stocks that they own. The equity that each fund owns could appreciate dramatically in value. This is what we hope is going to happen, and we want to make sure that those distributions from those funds are not taxed directly, that the tax liabilities are propagated, to the LPs and the GPs, who already have mechanisms for dealing with those kinds of issues anyway. Okay. And each fund is, as it says here, a limited partnership. This means that the money is coming from the LPs, the limited partners, and in most cases, that's like 98 or 99% of the money is coming from the LPs, and 1% or so is coming from the general partners. The general partners are making all the investment decisions. The LPs, as it says, limited partner, which means they have no say generally in what's being invested in, except when you raise money from LPs, you usually do so with a book that describes the fund's investment thesis, its focus, how it's going to do it, all the rest of that kind of thing, where you're going to lay down the criteria for your investments, and the LPs have signed up to that layout that you've put down. And so if you want to change that, say a deal comes along that's just so attractive, but it doesn't exactly fit the investment thesis you've sold, then generally speaking, you need to get LP approval to do that. So most people try to avoid doing that. The last entity on this picture is the management company, which is the entity that actually runs the fund. And this is how you pay salaries. This is how you hire staff. This is how you fly around and go to meetings, all the rest of that stuff. The management company is the entity, usually an LLC, that is essentially spending the management fees. And so that brings us to the next idea here. What are the economics of these things? And of course, each one can be unique and different. But here for the first fund we've laid down here, the general partners work for the management company effectively, and they make the investment decisions that Fund One is going to make. The economics of these things are typically management fees, 2% per year, are paid to the management company to run the place, keep the lights on, and so on. And then a carried interest factor, usually around 20% of all the returns, are then distributed back to the general partners and other staff members in the management company, depending upon a formula that the GPs usually set up. And so there's this, the carried interest is what aligns interests across the LPs and the GPs. It's an everybody wins kind of thing, or everybody loses. And in many, many funds, the management fees are, for a successful fund, completely returned, to the LPs across the life of the fund. In other words, you generally create returns that are net of management fees. And of course, each fund is going to invest in a series of portfolio companies that the general partners select through some process that they have set up. And the equity that's exchanged into the fund for financing the company is in the form of preferred equity. In other words, preferred shares, not common. And this is very important because we could have a whole session on what these term sheets look like. And in the VC Unlock program later in October, we'll have sessions where we really dig into the details around what these term sheets look like, what they need to look like, and things like differences between, you may have heard of East Coast term sheets and West Coast term sheets, all this kind of stuff. You still see some of that kind of stuff, but we'll show you some really obnoxious term sheets so you can understand what's investor friendly and what's founder friendly kind of ideas. And it's important to understand what these things are. The most successful early stage funds have very simple vanilla term sheets because the underlying reason is because if you start loading the term sheets up with tricky stuff, then the next investor is going to want all that too. And then this is going to create a very, very ugly preference stack for the portfolio company. And in some cases, it may make the portfolio company unfinanceable. And this is not a good thing. This doesn't align interests well with your founding entrepreneurs. So how do these funds, create returns to the LPs, the investors, and create carried interest for the general partners? And generally speaking, there are four avenues to this. In some kind of rare instances, you may have a share purchase buyout. For example, our fund position in a portfolio company, a bigger investor may come in and said, well, you know what, you've been in this deal for a couple of years, you got a nice gain. We're interested in the long term for this company. How about if we just take you guys out? And this happens every once in a while. We've done it a few times. But depending upon the life cycle of your fund, this may be of interest. Simply because most of these funds, like we just showed in the previous slide, usually have a 10-year life. And if you're very close to the end of the lifetime of that fund, you need to close it. And in those instances, this kind of an offer may be attractive because it allows you to liquidify the investments prior to closing the fund. But it's not done all that frequently. More often, and the usual exit opportunity is mergers and acquisitions. Somebody's going to buy that portfolio company, and a large company comes in, Cisco or fill in the blank, comes in and says, okay, we're interested in acquiring this company. Let's talk about a deal. They may also be kind of associated with this private equity buyouts. It's not being acquired by another company in the industry, but it's being acquired by a private equity firm. And this happens more and more these days, as I'm sure pretty well noticed. And then, of course, there's the usual IPO track. This doesn't happen all that frequently, but it's happening more frequently now because of the SPACs. And these special purpose acquisition vehicles, which are essentially reverse mergers, into public entities. And we can talk about that more later if that's of interest. But these are becoming more common routes to liquidity for venture investors. Now, just to review, this all sounds really nice and really rosy, and boy, this is really exciting, and this is really an easy way to make a lot of money. Yeah, I wish that were true, but unfortunately, it isn't. This is really hard business, and you really, I don't think I have worked harder in any company than in one of my venture funds. Because you remember, as a general partner, you're on the line to produce returns for the LPs. That's your job. And everybody says, oh, this is fun. And we go to meetings and we talk to other investors and entrepreneurs, and this is just really great. And it's very exciting business. But at the end of the day, you have to deliver the results to the LPs. This is a very serious business. And this is really difficult to do, because if you look at this and say, well, what percentage exit, like it says here, and you'd say, oh boy, well, exits above 100 million, piece of cake, must be at least 20 or 30% of the deals that do that. Yeah, really? How about this? Okay, so this is more like what the real numbers are. And so what this says is that, and I'm sure you've heard that probably on the average of any across a whole lot of different venture funds, maybe as much as 70% of all the deals they do don't work. And even after all the diligence and everything else that everybody goes through, the process, the rigor, really checking everything out, you would say, well, gee, we ought to do better than that. But on average, you don't. Now, certain top tier firms in the top 25 percentile do better than this. And that's why they're top tier. Okay, they do better than this. But still, this is extremely difficult to get these returns, and you shouldn't think of this any other way than this is really difficult business. And you can see this here. This was from 2004 to 2013, but only 4% of investments have greater than 10x returns. Oops, oh boy. So we really have to figure out how to do this. And we'll talk a little bit in a few minutes about some other approaches to making this better. But you have to give up a certain number of things. But this is generally true for venture funds that are hunting unicorns. Okay, think of it this way. You're going to do a certain number of deals across, depending on how big your fund is, and you're depending on a few of them having really big returns in order to make the fund work. Okay, that's what this picture is telling you. And an example I'll give, Kleiner Perkins Fund 8, for example, which goes way back, many years ago. But pretty much every deal in that fund failed. Every one, except one. Google. Oops. Okay. Well, that was big enough to fix everything and, made the fund work. But that gets to be pretty dicey, right? When you're down at the end and you're depending upon one company in your portfolio has to succeed, otherwise you're in big trouble. And the return profiles don't look good, and the funds don't return capital. So this is not a fun situation, and I've seen it a few times. Luckily, the funds I've been involved in never had that problem, but I know plenty that have. And so, don't take it lightly. So a real quick review here of fund dynamics so that we can all be on the same page here. So most funds investment period is right around 3 to 4 years, somewhere in there. We usually start cutting things off just a little over 3 years for new investments. Most funds have a lifetime of 10 years set up. And some extensions can be permitted with approval of the LPs. A lot of times you're going to reserve about half the fund for follow-on investments in the deals you've already built, you've already created in your portfolio. And of course, if you're successful, you may have multiple funds running at the same time. But typically, you're not doing any new investments out of those funds. And the management fees that you are collecting typically taper off. There's usually a formula for each one. And then after the key investment periods, the management fees may be in a taper, which is, of course, LP friendly, and I believe the right way to do it. So, and then of course, everybody knows, the money you have left over that isn't invested yet is dry powder. And sometimes, possible portfolio companies will want to know, well, it seems like you're kind of late in the fund here. You guys have enough dry powder to do my deal? That sort of thing will come up. And so from a fund dynamics point of view, we're using $100 million example here as a fund size. And so in a $100 million fund, you might have, say 10 to 12 investments, maybe. And so I'm only showing 4 of them here because this is kind of a cartoon, and otherwise we wouldn't even be able to read the slide. But here we have a case, kind of interesting, where company 1 really had an early exit. We invested, and inside of the 3.5-year active investment period, boom, we got this thing. Company 1, 2.5x return in 2 years, 58% IRR. Awesome. This is really cool, right? Yeah, maybe. Okay. And in a longer presentation, we would have a big debate about this, but today we don't really have the time to do that. But these other 2, company number 2 and 3, well, not so much. They kind of flamed out, or we got a little bit of money back on company 3. On company 4, we made 2 investments there, the way it shows, and we got a 10x return in 7 years for 45% IRR. Not as good as company number 1. So the question then is, which one of these, 1 or 4, is better? And there is a number of ways you can look at this, but basically, company number 1 is a total waste of time. Okay? In other words, if that's what happens, we put a lot of effort into a dog, really. And people would say, but wait a minute, 58% IRR, this is awesome. This is really great. And look how fast we got it back. Yeah. So if the fund were a $10 million fund, that might be good. For a $100 million fund, it's a waste of time. Why? Because it doesn't return enough of the fund to matter. Remember, in order to make this $100 million fund successful, we have to return, over $300 million, or we didn't do our job. All right. So I need big returns like number 4 in order to get a significant percentage of the fund returned. That's the way to look at this. IRR doesn't really matter. What matters is cash on cash and returning significant percentages of the overall fund. That is what you're shooting for. And so this is where the unicorn hunting idea comes from. So let's suppose not a $100 million fund, but let's suppose this is a $400 million fund. Now, in order to return enough money on that size fund, I need to return over $1 billion to the LPs in order for this fund to succeed. Well, the only way I'm going to do that is if I've got some unicorns in here, okay? So I'm hunting for unicorns. And when I'm looking at deals, I've got to look at them in that light and say, can this be a unicorn? Okay, because if the answer is no, we're going to pass on this deal because it doesn't help the fund. But if I have a $20 million fund, and we'll see in a minute, this is where floodgates started, No, I don't need a unicorn to succeed. I only have to, for for a $20 million fund, I only have to return 60, $70 million to the LPs, and I'm a hero. I'm rocking. Okay. And remember that some very large percentage of the probability of an M&A exit in the into the say to the 50 to say $500 million range of exits is about 19 times more probable than hunting for unicorns. And so, oh, now we got a new game. Okay, so it depends very much on how big the fund is, whether you're going to get this done right or not, and what problems you actually have to solve. I suggest, just for fun, or for some planning work you may want to do, is you can go to this link here that we have. This is one of the links from the 500 Startups VCU program, which we'll be doing in October. Vanessa, I give a little plug here for the program, but you can use this now. You can go to this link, and it'll provide a portfolio spreadsheet where you can build a what if kind of portfolio. Well, suppose we have this many deals and this big, and we invest this kind of money, and over this amount of time, gee, what does a thing look like? And you can kind of simulate all of this and see if you like it, and play what if games and say, but no, let's change the assumptions and let's do this a little bit and see what that looks like. And that's always very interesting. We're big fans of financial modeling for startup companies, because this allows them to pull all their assumptions together in one place. This is the same thing for a venture fund. You may be able to understand how to build your portfolio nicely by going through some of these exercises as homework. And in the VCU program, of course, we'll really highly encourage you to do that then, later in October. So I mentioned Floodgate earlier. This is roughly what they did. I don't claim this is exactly accurate, but I think this is pretty close. And what we're interested in here is looking at their early funds. They started out very small. And by the way, over the years, they've kept it pretty small. In other words, you don't see in here $400 million funds. Notice that they're still adhering to their basic principles, namely, go very early stage, work very tightly with entrepreneurs, and make sure they're successful. And that's the overarching principle that Mike Maple started with very early. He's very successful doing this. It's extremely successful fund, and many successful exits out of this. So, summarizing, as the fund size gets smaller, which is where most folks have to start if they're early to the venture game, then you really, you're not doing so much overall portfolio management as you are really deploying a very focused hands-on strategy. And here is where operating expertise really comes in handy. In other words, if your background is financial management and that sort of thing, and you've never actually built a company, then you have a bit of a disadvantage, and you want to have some folks on your team who have actually worked closely building companies, or worked very closely with entrepreneurs, because that's going to pay off much bigger. I'll give you an idea of one such focus mechanism, and yours can be very different. This, I'm not suggesting you do this. It is if your team has the backgrounds and the interests and the connections and the ecosystem and all that kind of stuff to do this, you can do this. This is what we do. but your experience will be different. Don't try this at home, right? So this is what we do is we have a focus in national security. And so we work a lot in reducing operational risk for companies, including cybersecurity and things of that nature, um, data tracking and audit, AI applications to security, and so on. And so this is a very heavy tech focus, as you can imagine, and all the people associated with our fund are very heavy government tech types with a big network of connections into those industries, because without that, you wouldn't be able to do this. And we've commercialized lots and lots of government funded technology. One obvious one is when you go through the airports and you're scanned by the body scanner machine. That's one of ours, and one of our products. I apologize for that in advance, but without it, the airports have no security at all, and you don't really want to know any more than that. So we start, usually with early stage entrepreneurs, EIRs, executives and entrepreneurs and residents, folks in our network who are able to build these kinds of things. We use a lot of stranded or untapped intellectual property that comes out of government labs. There's so much of it, you just wouldn't believe it. And then we put companies together or accelerate ones that have already been put together to get the right product market fit faster than you normally would see it. And these companies are usually built to exit in under 5 years. And this is how we're modifying the return curves. I'll show you a picture of that in just a minute. And we're essentially running an innovation factory. It's a venture studio. Your market focus, your approaches, your things will be totally different. But having a keen, really sharp focus is one of the keys to getting earlier, faster returns. Now, here's a little bit more information on our approach, but we're leveraging what it says on the left and what it says on the right. We not only have a multi-hundred billion dollars of generated intellectual property that's never been commercialized. It's truly a crazy situation. And the government is actually engaged Stanford a few years back to teach licensing executives how to generate, more commercialization, because it's really very poor. And then on the other side, there's a really multi-hundred billion dollar M&A market for these kinds of companies. And so it's an interesting ecosystem. If you have the right folks on your team, you can do this kind of stuff.
Mike, sorry to interrupt. I was going to say that we have about 5 minutes left.
Roger that. And I'm just about done. So I think we're very close to time. Thanks, Vanessa. So you do have to have a process. Whatever it is you're doing, you need to manage it very tightly and understand the stages of investment and when you're going to invest more money in these deals or shut it off. So I've shown you a kind of an initial strategy here for what these things can look like, where you, especially if you're starting one of these enterprises, you might invest $250,000 to get the EIRs off to the races, and creating what the opportunity assessment might actually look like. If it looks exciting, then you start investing more money. If it doesn't, you drop it and move on to the next thing. We've worked it both ways. And so you get an idea here for how this goes. And what you want to do is manage the process in such a way that, as it shows in this lower right-hand figure here, on this picture here, is you want to be able to keep interests aligned. when you're doing this kind of thing. In other words, the founders of the company have to have major ownership stakes in these entities. The investors have to have ownership stakes, and the ecosystem of the whole company, everybody has got to be on a aligned, equal footing. As soon as these capitalization tables get distorted in any kind of really crazy way, then you're creating entities that are fundamentally not financeable. And this is very dangerous for the entity, because one of these things gets exciting and starts to grow really fast, other investors come in, and the structure of these companies needs to look, what we'll call Sand Hill Road normal. In other words, yeah, this is vanilla. It's just the same as everything else we do. No big deal. Looks great. Many companies that are seed funded in places like Europe end up with massively distorted cap tables, which makes them unfinanceable. And it's something we'll talk about in October in the main program. So this is what you're trying to do with this kind of focus and this approach. You're trying to shift the distribution return. Now, you can't do this if you're hunting unicorns. That's very difficult to do. But if you're doing this smaller fund size, like Floodgate started out with in the very beginning, you can do this. And they indeed did it and produced very successful exits. So there's some resources here in the deck you can go for, and there's lots of other ones to look at. And I think to wrap it up here, there are a lot of ways to look at creating new funds. You want to have a clear focus and an investment thesis. We'll talk about later in October. Usually, if you're just starting out, it's going to be a small fund, which means the usual institutional LPs will probably not invest in it, but family offices and other, high net worth individuals would be interested, depending upon where you're going, your thesis, and so on, and what your backgrounds are. Again, big funds, a lot of financial engineering, or you accelerate smaller things, make smaller investments, and do a lot of hands-on stuff to make sure your portfolio companies succeed. That's the key. So let's do it. Questions?
Perfect. Thank you so much, Mike. We have a few in the Q&A. So for those who haven't used that function yet, feel free to send them through. So first one, a little bit earlier from your presentation, you went over management and carry. So the question is, in your experience, how standard are fees, management, and carry across geography, example, around the world? Should one expect some deviation, or is this relatively fixed globally?
Well, that's a great question. First of all, if you're a very successful fund manager, and you're working on fund 5 or whatever it is, and you've returned really great returns to the LPs, you of course have leverage to say, well, the carried interest on this fund is going to be 25%, not 20. And you may be able to get away with that. And certain large, successful Sand Hill Road firms have been able to do that sort of thing. And so that's not out of the question. You may also go the other way and say, we're new at this game. We want to share more with the LPs. And, for our first fund, the carried interest is only going to be 10 points or something like that. I've seen that too. And it just depends upon how you're getting along with your investment base. Also, I would add here is that it's very important putting together a new fund that legal counsel is correct. So there are certain firms who are very, very good at assembling venture funds and know how to do this extremely well. I'll mention 2 in the Valley here, Cooley, and Gunderson are probably the top 2. And this is not something you want to go low rent on. when you're putting a new fund together. You need to use well-known firms where the LPs will say, oh, okay, they've got the big dogs on this. That's good. That sends the right message. If you've got some inexperienced firm that might be good at other things, but really has no experience in building venture firms, you're making a terrible mistake, in my view. Don't do it. Get it put together right to begin with. The same advice we give to people building new companies or starting new ventures. You don't want to use your cousin's divorce lawyer to put together your corporate documentation. This is just a really dumb idea, and don't do it. So I think you can get different terms, carried interest for sure. You can reduce fees. You can do those things as you're starting out, but be mindful of the objectives of the fund and the costs you're going to incur to actually run it. Right. So just make sure these things are modeled out and lined up so that you know what you're doing when you're changing these numbers. But 2 and 20 is very common. Any more than that starts to raise red flags. And you have to have, some people with a very small fund may say, oh, I need 2.5% on management fees because it's really tough to, pay the bills. And that's all true. And you may be able to get that. On the first fund, one of the funds I did, not the first one, but it was a $20 million fund and we had 2.5% management fees. But, you have to see what the appetite is for your potential LPs. Okay.
Thank you so much, Mike. Another good question is, as a founder, fit with GPs is important. As a GP, how important is the fit with LPs? Is it a similar relationship?
Well, I mean, I'll just give you my opinion. And it, I've seen funds, I've been with funds where the relationships with the LPs was a little bit cranky. And yeah, that's not a lot of fun, but it does happen. And especially as the fund sizes get larger. But it's much better to have, you want LPs who are lined up with your strategy, what you're doing, and you want to be able to call them and say, hey, Bob, we're looking at this sort of thing here. What do you think about it? And I like to involve the LPs in sort of informal discussions around various directions and other things like that, because sometimes and frequently the LPs are really smart about that. Those are the kind of folks you want. And their advice sometimes can really be valuable. And you go, oh, I didn't think about it like that. Hey, this is really great. Okay, yeah, we're going to give that a try. Thanks. Hey, I'll touch base with you later on how we did with that. But we're going to try that advice. And that also builds trust across the LP-GP axis, because then the LPs say they know how you think and you're involving them in the thinking, even though they're not actually making the decision because they can't. Yeah, it's your job. So I hope that helps.
Thank you, Mike. One question here, a little bit more broadly. If you could talk a bit more about how you view the VC scene in Europe and how it might be different, or just curious about things you've observed.
Well, things I've observed, I want to say, certainly 6, 7, 8 years ago, it was not good. Everybody joked, not incorrectly, that venture capital really looked more like private equity, or investment banking or something. In other words, the way they were looking at deals, there weren't that many of them, and the terms and conditions they were creating for these investments were destructive to the portfolio companies. Now, that being said, over the last few years, especially what I've seen in France, has been quite different and really dramatically improved. And for example, in the in the Stanford program we do in Lille at the Eurotechnologies incubator. We're a wonderful incubator, just very large too, like 130 companies in there or something. It used to be in the beginning really tough to get VC judges for these companies and presentations and so forth. Last few years, not so. There are lots of them and really good ones too. So I got to say, it looks like this has changed significantly in just the last couple of years. Now, I don't have a good test on this over the COVID period here, but we'll get another sense of this, I would say, I think early next year in Q1. So more info later.
Perfect. TBD. Another question, a hypothetical question. So for 100 million fund, what would, in your experience, be an ideal number of investors / GPs to properly manage the portfolio companies?
Yeah, sure. Good question. And so in terms of fund economics, the notional number is $50 million for GP of fund size per GP. You'll hear that thrown around a lot. So for $100 million fund, 2 GPs would be the number. There are several really successful funds of that size where there's only one GP. I won't mention the name, but they're doing really well. And it's a single GP setup. But for 100 million, you could, for a first one, I think you could easily do 3 GPs would be okay in that. But also remember, the management fees are going to have to be distributed to other staff. You're not going to be able to do all the portfolio work yourself. And then again, it depends on how you're operating the fund. If you're doing what we do, a lot of cycles go into helping, managing, and creating portfolio companies, whereas in many traditional $100 million funds, the GPs are spending most of their time listening to entrepreneur pitches and doing that kind of stuff. You might have, make it up, 10 pitches a week or something like that, and you're listening. So it's absorbing a lot of cycles doing this. But, especially if you're hunting for unicorns, you have to do that. You're kind of stuck. So I hope that helps.
Perfect. Thank you. What is your position on offering hurdle rates?
Sometimes you have to do it because the LPs want it. And we had it on one of our funds, and we were, luckily, that fund was Cambridge top 5 percentile, and hitting the hurdle rate was no big deal at all. But yep, especially a lot of times on a first fund, you may have to do that. And I don't think there's anything wrong with that either. I mean, you're basically sending the message, hey, look, we believe we can do this. And that, you're sending that message, hey, we're bought in here to this. And when you're on, anytime a group comes together to raise a fund, unless it's fund, N+1 of what you've already been doing, you're considered by LPs as a new manager, regardless of your experience. And, you may have to do things in the terms to get them on board. So I don't see anything wrong with it. I mean, the hurdle rates we had were not super big. I mean, they were like 8% or something. But you don't want to have a, giant hurdle rates. I mean, that doesn't align interest. Let's put it that way.
Wonderful. Thank you. So I think just one last question since we're approaching the hour mark. But this one also broadly speaking, what about VC funds with impact focus? So the impact versus financial returns, what are key factors for success?
Yeah, I know I'm a big fan of impact funds, especially now. where there are so many problems with diversity, employment, all these sorts of things, and trying to help folks build, exciting lives and productive careers and that sort of thing, and getting a social impact to society. I think it's extremely important. The one cyber academy I'm running right now is definitely focused on that, because we're focused on COVID displaced and veterans and all kinds of folks like this. I mean, there are a million unfilled positions that are five-figure salaries for people that can cut it, and degrees don't matter, not necessary. And most of the positions don't require degrees. And so we got to do something. What's going on socially is not good. So I'm a big fan of impact funds. And I think there are a number of LPs which share that view as well, and especially around diversity as well. I know that Silicon Valley Bank has a new fund of funds they recently put together, and that's heavily focused on backing diverse GPs. And so, something to consider as well.
Perfect. Thank you so much. So that's all the time that we have for questions today. I know it goes by very quickly. Thank you again, Mike, for your time and your expertise today. We're really excited again to have you in this fall's program. So really, we're going to be sending out a recording of the webinar to anyone who registered, so you'll be able to rewatch it. And then, of course, if you were interested in this fall's program for VC Unlock Silicon Valley Online, we're coming up on our next deadline for general applications, which will be July 30th. And if you have any questions about the program or today's webinar, feel free to reach out to our team at VC Unlocked at 500startups.com. Thank you so much. Have a great day.
Yeah. And thank you, everybody. And maybe we'll see some of you in October.
Yeah,
Okay.
definitely.
Have a great day.